about to hear my conversation with Luc Lafleur, Assistant Vice President of Portfolio Construction at Mackenzie Investments. We'll talk about how advisors can optimize portfolio construction with ETFs and how ETFs can contribute to running efficient advisory practices. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. I'm your host, Prerna Matthews, Vice President of ETF Product Strategy. Today, I'm joined by Luc Lafleur from our portfolio construction team. Luc, thank you for joining the podcast today.
Thanks, Prerna. It's great to be here.
So investors have enjoyed a very positive first half of the year in global markets with fairly low volatility, yet still expensive investment opportunities. And in fixed income, uncertainty around timing and magnitude of rate cuts in Canada and the US have also contributed to heightened bond volatility. From a macro perspective, we're seeing more signs of economic nationalism, increased geopolitical tensions. There's also the raising trade barriers, such as tariffs, trade wars. Those are disrupting our global supply chain, certainly. And of course, advances in technology like automation and artificial intelligence. They're all encouraging companies to think about bringing manufacturing back to their home countries. So there's a lot going on from an economic perspective. How do these economic drivers impact portfolio construction decisions from your perspective, Luc?
Yeah, these are definitely big topics, and there's no shortage of media coverage that can cause us to lose focus or control over our portfolios. So I'd say a couple things on it. It's important to stay grounded on very core and proven investment principles like long-term focus, diversification, and discipline. I understand it's obvious, but it's also not easy, but it is critical to achieving our goals. So if I think about globalization, there have been patterns of globalization and deglobalization over the last century, where there was a surge in global trade post the two world wars. And it was characterized by hyperglobalization between 1990 and 2008, where we saw extensive global value chains and trade networks get created. However, subsequent events have derailed that trajectory. If I think about global financial crisis, trade wars, COVID-19, more recently, the war in Ukraine, and the political and ideological differences we see globally seem to be reaching a feverish pitch. So I think what we need to do, and this is the second thing, is we have to be strategic in our approach and not be binary or arbitrary about it. If I think about globalization, while it is taking place globally, it's not uniform, and it can vary by demographics. So I think we need a balanced and thoughtful portfolio construction approach based on the principles I highlighted. And active management here can really add a lot of value, specifically to the main drivers that you highlighted before. So we want to address these trends by being thoughtful and not make any knee-jerk reactions that can adversely impact portfolio outcomes.
Those are great points and sound advice, Luc. How do we think advisors should approach portfolio construction decisions in the current market environment?
Yeah, it all begins with setting a strategic asset allocation, Perna, and that has to be calibrated to investors' goals, objectives, their risk appetite, constraints, and preferences. That never goes away and is really fundamental. Asset allocation, as you know, is a major, and that's an understatement, determinant of returns and return variability. So setting the asset mix upfront is a crucial first step. ETFs play a very important role here, and we see this through the success that asset allocation ETFs are having.
Very true. We've seen continued strong flows into asset allocation ETFs year to date. I mean, since inception of these products in the Canadian market, certainly. So advisors and investors have found a very useful place for these types of active ETFs in their portfolio. Let's talk about that for a few minutes here. We're seeing substantial increase in the growth of active ETFs globally. Year to date, something like 25% of asset flows have gone into active ETFs, according to Morningstar. Your thoughts on that?
Yeah, it's very interesting, Perna. I think one of the first things we need to do is define active in this context. Active can refer to fundamental, bottom up active investing, and that's the one our listeners are probably the most familiar with. It could also be a rules based active or smart beta. It could be factor based active, or it could be active with passive by taking strategic tilts or making tactical calls using passive indexes. We see this quite a bit through the advisors that we engage with. An important comment I would make here is to dispel a myth that I've heard a few times, and that is ETFs are a light or watered down version of their mutual fund counterparts, which is simply not the case. They are merely different investment vehicles through which I would still say you need to look under the hood to understand the investment process and the expected exposures. Going back to the asset mix, once it's been set, the next step is to fulfill it with investment products. And this is where the active and or passive decisions take place. I mentioned earlier, it's important to not be binary or arbitrary in our approaches to portfolio construction. And this is certainly true of this step in the process. These could be very emotionally charged decisions regarding I don't do passive or vice versa on the active side. Or we've seen it be very arbitrary where like the flip of a coin, we simply make a 50-50 allocation between the two. We believe an approach that first considers the asset class or market's efficiency is a good starting point. Then, it is a matter of assessing alpha expectations of the active managers, what is expected in terms of risk and risk tolerance. If there is high confidence in the managers, little active risk, and there's a high tolerance for risk, then we'd be looking at higher allocations to active in that portfolio or model. It all comes down to talent alongside risk and fee budgets.
It's definitely been interesting to see the types of allocations made by advisors across different types of products. Certainly a lot of allocations to strategic exposures in ETFs across different asset classes and types of ETFs, but there has been a lot of tactical allocation being made to all sorts of active ETFs. I'm sure you're seeing that as well from a portfolio construction lens.
Yes, definitely. My previous comments were focused on strategic asset allocation as a foundation for portfolios. That being said, we do see a strong demand for tactical asset allocation ideas and how to implement them into strategic portfolios. When it comes to tactical allocations, determining the time frame you're looking at is very important while respecting the difficulty in forecasting short-term market movements. For these tactical calls, you should consider asset class valuations from both a relative and absolute perspective, the macro environment, and market sentiment. It is then important to evaluate your portfolio to understand what your current exposures are so that you can size your tactical positions accordingly. As an example, if you're taking the view that value should see a short-term run due to a variety of different factors, you should ask yourself, how much value exposure does the current portfolio have? And would adding more create undue risk with an overconcentration to that factor? All portfolios have factors embedded within them. The question is, are you being compensated for them? It comes down to being intentional. Another important principle I would put alongside being long-term focused, diversified, disciplined, and intentional is very, very important when it comes to tactical asset allocation.
So, Luke, what are the most common mistakes then in portfolio construction that advisors make, and how can they avoid them?
Unfortunately, chasing past performance, and I would add recent past performance, is the biggest mistake we see. It's such a strong behavioral bias that so many people have. And in the culture we live in, you understand why it happens. The problem is it just doesn't drive better outcomes when it comes to successful investing. It leads to overconcentrations in risk in portfolios and creates a misalignment with client goals and, importantly, their risk tolerance. There's a lot of evidence of this that we see through the portfolios we optimize in our portfolio construction service or through third-party research, and certainly in industry flows, something I'm sure you can attest to. On the other end of the spectrum, we see portfolios that are too conservatively positioned, that could be optimized for better risk-adjusted returns, that would put them in a better position to achieve their goals. We help clients in both scenarios optimize portfolios by leveraging concepts such as the efficient frontier and by using strong risk management tools and approaches. What it comes down to is a disciplined portfolio construction process and moderating or mitigating behavioral biases.
Oh, very true, Luke. We did put out a piece on our ETF blog earlier this year on behavioral biases that are often driven by our emotional reactions rather than that rational analysis. Whether it's selling prematurely, having overconfidence in our investment expertise, seeking out information to confirm our own biases or existing beliefs, or following the crowd, the herd mentality. The rebalancing, for example, it can be very difficult for many advisors, investors, even some portfolio managers, to be honest, to stay disciplined. And that's a key driver, as we know, of staying on track toward your goal of financial planning and investment. So we've talked a lot about the importance of goals. We've talked about preferences. We've talked about portfolio construction and discipline. What role do you see ETFs playing in advisors' books from an efficiency perspective?
That's a great question. There are so many use cases for ETS within an advisor's book. I really think about them as a Swiss Army knife and one of those good ones with lots of tools at your disposal. If I go back to the foundational concept of strategic asset allocation and diversification, ETFs play a pivotal role in providing a strong starting point through a low cost foundation with an asset allocation ETF or a static tilt to a certain asset class to complete a portfolio. Tactically, which we also talked about, ETFs are a great tool to provide cost-effective and easily implementable, and that's key to your question on efficiency, access to active management, or a great tool for advisors to tactically dial up or dial down exposures through passive ETFs. And that's that active with passive concept I referred to earlier. From an efficiency perspective, they're also a great way to equitize cash until a model is fully deployed, and it can be used very quickly to rebalance a portfolio that has drifted offside from a compliance perspective. Speaking of rebalancing, you just talked about it, that built-in function within asset allocation ETFs can alleviate a lot of the trading, as you pointed out, and instill that discipline by automatically selling some of the winners and buying the losers. There's also, from a demographics perspective, a predisposition to ETFs and sustainable investing, something I see ETFs meeting a strong and growing need for. Finally, in my experience, when ETFs are leveraged effectively through many of the use cases I've highlighted, there's the added benefit of statement love, I'll call it. Clients like seeing ETFs on their statements, and when you can weave that into a complete portfolio construction story, that is very powerful.
Well said, Luke, especially in the context of the continued changes on client statements as it relates to CRM3 and total cost reporting. More and more conversations are going to be had in the advisor's office that advisors are going to be having with their clients on different types of product vehicles and the value and benefit of those different solutions to portfolio outcomes. Thank you so much, Luke. That brings us to the end of this episode of The Invested.
Thanks, Berna. We're dedicated to helping drive better outcomes when it comes to investing, so thanks for having me on.
Thanks, Luke. Appreciate you sharing your insights with our listeners. Today, we explored the critical role of ETFs in optimizing portfolio construction and running efficient advisory practices. To recap, we discussed the impact of global economic drivers on portfolio strategies, the significance of setting a strategic asset allocation, aligning with investment goals, the balance between active and passive investing and everything else in between, common portfolio construction mistakes and how to avoid them, and the versatility of ETFs in both strategic and tactical allocations. Thank you to our listeners for tuning in. We hope you found this discussion valuable. If you have any questions or topics you'd like us to cover in future episodes, please reach out via our ETF blog or through LinkedIn. Until next time, stay invested. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially value from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.